You've probably heard of machine learning for things like image recognition, right? But what if you could take that same kind of powerful tool and apply it to the incredibly complex world of finance? That's exactly what we're going to dive into. We're exploring how support vector machines can be used to build a dynamic investment strategy, going way beyond simple classification and into sophisticated forecasting. All right, here's our roadmap. We're going to start with the absolute basics. What even is a support vector machine, or SVM? Then we'll get into this really cool thing called the kernel trick, which is how it handles messy real-world data. After that, we'll see how it evolves from a classifier into a forecasting tool called SVR. And finally, we'll put it all together to see how this is actually used to make tactical investment decisions. So let's kick things off with a big idea. When you boil it all down, a support vector machine is all about one thing: finding the single best way to draw a line between two different groups of things. At its core, an SVM is a classifier, and it's what's known as a supervised algorithm, which is just a fancy way of saying you train it on data that's already been labeled. Its whole mission is to look at all that data and find the absolute best dividing line, or hyperplane, to use the machine learning term, that separates the data into distinct groups. You can think of it like teaching a computer to make a decision between, say, buy this stock and sell that stock. Now, this brings up a really interesting challenge. I mean, if you have two clusters of data, you could draw a whole bunch of different lines to separate them, right? So how does the machine choose? Out of all the possible options, which line is the absolute best one? And this is where the genius of the SVM comes in. It's not satisfied with just any line that gets the job done. It's specifically designed to find the one single line that is as far away as it can possibly be from the closest data point in each group. It's trying to create the widest possible cushion, or what we call the margin, between the two sides. This right here is exactly where the name support vector machine comes from. You see, the data points that are sitting right on the edge of that margin, those are the support vectors. They're the most important points in the entire data set because they literally support the hyperplane's position. You could move all the other points around, and as long as they don't cross that margin, the line wouldn't budge. But if you move a single one of those support vectors, the whole optimal line has to be recalculated. Okay, so that all makes perfect sense when your data is in nice, neat little piles. But let's be honest, the real world is almost never that clean, right? Well, this is where SVMs get really, really clever. So what do you do when you just can't draw a simple straight line? Imagine your data isn't in two separate blobs. What if you have one group of data points that's completely surrounded by the other? A straight line is suddenly pretty useless. Here's a great way to picture this. Imagine you've got a string of pearls laid out flat in a line. You have red pearls on both ends, but in the middle you have a bunch of black pearls. Now, how do you separate the colors with just one straight cut? You can't. There's no way to do it. This is what we'd call a non-linearly separable problem. And here comes the magic. It's called the kernel trick. It's basically a mathematical function that projects the data up into a higher dimension. So it takes that messy, one-dimensional line of pearls and transforms it into, say, a two-dimensional parabola. All of a sudden, the black pearls are at the bottom of that U shape, and the red pearls are up on the sides. And just like that, separating them is easy. You just draw one horizontal line. Problem solved. It's brilliant. So we've seen that SVMs are fantastic at classifying data, sorting things into clean categories. But for something like tactical asset allocation, we need a little more. We don't just want to classify an asset as good or bad. We actually want to forecast a specific value, like its future return. This means we have to make a pretty big mental shift from classification to what's known as regression. The entire goal changes. A classic SVM wants to assign a label like buy or sell by making the empty space between the classes as big as possible. But for regression, we need to predict a number, like a positive 1.5% return, by finding the line that best fits within the data itself. This evolution of the tool is called Support Vector Regression, or SVR, and it totally flips the whole idea of the margin on its head. Instead of trying to create a wide margin to push points apart, SVR creates a tube or a street around a central line, and the new goal is to fit as many data points as you can inside that street. It's an incredibly smart way to find the real trend in noisy data, like you'd find in financial markets. Okay, so let's put all these pieces together now. We have this really powerful forecasting tool, SVR. How can we actually use it to build a sophisticated, real-world investment strategy? A strategy called Global Tactical Asset Allocation, or GTAA. can be built using SVR in 4 main stages. First, the SVR model forecasts the future returns for a bunch of different assets. Then, and this is key, you feed that model a diverse range of input factors, which we'll look at in just a second. Based on those inputs, the model's forecast gets turned into a clear trading signal. And finally, you use that signal to optimize your portfolio, deciding what to own. But it all starts with the data you put in. To make its forecasts, the SVR model is fed 3 very different types of information to get a really holistic view. First, it gets macro factors to understand the big picture, the overall economic cycle. Second, you give it a greed and fear index to get a read on market sentiment. And third, it analyzes the momentum of each individual asset to understand recent price trends. The real power here is that the SVR can learn the complex, often hidden relationships between all these different drivers to predict what might happen next. So what's the big takeaway here? Well, SVR gives us a powerful and really adaptable framework for forecasting returns that goes way beyond simple models. By combining fundamental macro data, behavioral sentiment, and technical price trends, it creates this robust system for navigating complex markets. And this incredible fusion of machine learning and finance leaves us with a really critical question for the future. As these machines get better and better at this, what does it mean for the human investor? And that's how a machine learning classifier evolves into a sophisticated financial forecasting tool. If you found this deep dive helpful, please go ahead and hit that like button, share it with someone who might be curious about quant finance, and of course, subscribe for more explainers on complex topics. Thanks for watching.